Hey investors, welcome to this episode of InvestU. Today we're going to be doing analysis of Victory Capital. So we had a request from one of our viewers in our YouTube comments to do an analysis of Victory Capital. And we took this one on, and it was a very interesting review of a company that does a lot of investments in mutual funds and ETFs, and they have a lot of different franchises which are listed here. Some of the ones you may recognize are obviously Victory Capital, Munder, and the main ones are USAA and USAA mutual funds, though they say in their annual report that all of these operate independently, and we'll dig into why it's beneficial to have this under the Victory umbrella. So just wanted to say thank you to the viewer for asking for this analysis of this stock, and if you have any suggestions for tickers for us to review, please post some comments in YouTube or send us a note at info@valueinvestu.com. Okay, a bit of basic info about this stock. So the ticker is VCTR. It's traded on the NASDAQ. This analysis was performed on the 14th of May, 2020. It has a market cap right now of $1.03 billion. The stock is trading at $14.50, and there are 70 million shares outstanding. So here are our investing rules for InvestU. I'll paste a copy of this in the show notes below, and this is especially important to keep in mind as we enter into uncertain times in the market. We want to ensure that we're investing in stable companies that have solid financials, and we use this rule set to help us with that. Also, with helping us with our mindset in investing, there's a couple of books that I would recommend that will be helpful with determining which stocks we invest in. One of them, as mentioned before, is The Intelligent Investor by Ben Graham. He goes through a lot of these principles and why these statistics are so important. The other book that I recommend is by Daniel Kahneman, which is Thinking Fast and Slow. And what this book is helpful with is understanding your mindset when you're tackling difficult problems like whether to invest in stocks, whether to sell a certain stock, and which stage of thinking you're using. Are you using a stage 1 or a stage 2 approach? So I'd highly recommend these books. One is more focused on the psychology of investing or psychology of thought processes in general, and the other one is focused more on the financial aspects of things. Okay, some key metrics for this stock. So as mentioned, the price is $14.50. It has a PE ratio of 1533, which is less than the PE ratio of 20 that we're looking for as value investors. Has a good earnings per share of $1.26, which would translate into about a 9% return with a 0.19% dividend yield. So very close to a 10% return year over year, at least statistically. It has a price to book of 1.82, so that gives us a margin of safety of 54%, which is above the margin of safety of 50%. But we need to be careful with the margin of safety with financial companies. Usually they have pretty good books, as do insurance companies. So I want to really do a comparison of the price to book relative to the competitors in its industry, and we'll do so in a few minutes here. Debt to equity is slightly high at 2.26. Return on equity is not bad at 11%. It has a current ratio of 1.08, an EV over EBITDA of 7.48, which suggests that this stock is undervalued, and a fairly low correlation to the S&P 500 of only 0.15. It should be noted it does have a lower correlation to Waste Management, Tesla, Apple, and Netflix, which it has a almost zero correlation to those stocks. So from a portfolio balancing perspective, this one might be a good stock to have in your portfolio to mitigate any swings with the stocks mentioned here. So we'll look at the progression of some of the growth in revenue and net income, but it should be noted for Victory Capital that they did have their IPO in early 2018, so we're relying on a lot of stuff from their annual report for some of this data. From a revenue perspective, we do see strong growth from 2015 to 2019. Really good net income translation over those years as well, very strong growth. Total assets has gone up, and we'll go through the key acquisitions that they have done over time. And particularly, you'll see a big jump from 2018 to 2019, and we'll go to why that is in a second. And same thing with the liabilities. So as the assets went up, the liabilities went up because they have a lot more debt on their books. And we see that in the debt below as well from 2018 to 2019. And that is due to their acquisitions, which we'll get into. Great growth for shareholders' equity. The shares outstanding has been fluctuating a little bit over time. We do see that there are an increase in number of common shares outstanding and some slight decreases year over year. So that is something that we need to be concerned with for Victory Capital as to whether or not they are financing some of their activities with playing with the number of shares outstanding. Very much a fluctuating debt to equity, a strong current ratio as we see here, and really good earnings per share growth over time. It should be noted this stock does pay a dividend right now, but it's not a heavy dividend. This is not something that this stock is focused on or appears to be focused on at this point in time. So it's not something we should really rely on as an investor here. And great book value growth as well since 2015, and that's largely due to the acquisitions. Digging into some of the key metrics with their peers, we see that the dividend yield is rather low relative to other financial investment firms here. And it is actually quite a low yield. Most other firms do regularly pay out something here. So maybe Victory Capital will translate into doing that. But at this point, they aren't paying out much of a dividend. Earnings per share relative to the stock price is not bad. There are a few other companies that are a little bit better here in terms of what their returns are. Some are closer to the 10% mark, but overall, it's a pretty good return. Has an average PE ratio, definitely not as high as some of the other firms here, but some other firms have some lower PE ratios here. So I'd say it's an average ratio relative to its peers, and same thing with return on equity. Really good price to book, though. It's amongst its top quartile. And from a debt to equity perspective, a lot of fluctuation in terms of what investment firms have here. So I'd say this is probably an average debt to equity. So nothing too alarming here that we need to be concerned about from that perspective. Okay, again, it's not a big dividend payer, but we do see that the earnings do cover off the payout more or less. We have seen some quarters where it doesn't earn as much, but annually it does cover off the dividend payout. So no concern that they're paying out more dividends than the funds that they're bringing in. So the intrinsic value calculation was a little bit challenging for Victory Capital, and that's primarily due to its acquisitions. So if I look at the revenue growth over time, because they have brought on additional assets under management over the years, and really they had a big boom in 2018 to 2019, where they brought on $81 billion for assets under management. That led to a revenue growth of about 89% since inception. So what I was trying to look at here is just the growth of assets under management over time, which really had us around 43%. So that takes out some of the revenue component of it, and I thought that was a much better figure. Discounting that at 10% and using a growth rate in perpetuity of 2%, and using the 2019 free cash flow, we get a return of about $310 for the intrinsic value. If we use a smaller growth figure, and what I did was I pulled out the acquisition of USAA, which we'll get into, and I looked at the growth of assets under management with that being removed, because it is very tough to have a big investment firm being added on a regular basis. I still get a growth rate of about 8.89%, and if I apply that using the 2019 free cash flow, I arrive at an intrinsic value of $51. So this firm is definitely trading at a discount, and let's dig into some positives and negatives next. Okay, going into the annual report, it's very important to keep in mind that Victory Capital ultimately is an investment firm, so they get paid based on having money with their company. So assets under management. They have a multiplier of about 0.71%, which is where they earn their revenue. So the more assets they can get through either growing their portfolio, acquiring companies, that's how they're going to increase their revenue streams year over year. Especially as we get into challenging times in the market, there may be some issues with people pulling their money out of mutual funds and using it, being afraid of market conditions and pulling funds out, or having their funds underperform relative to the S&P 500 and having individuals move their money elsewhere. So they're very susceptible to this, but at the same time, they have shown tremendous growth over the years, and we hope that can continue. So they have a large number of investment vehicles and solutions available, so we'll go into what those are shortly. As mentioned, they have a strong history of acquisitions. So in July 1st, 2019, they acquired USAA's investment side of things, which has $81.1 billion assets under management, and this was acquired for around $1 billion. This helped increase the revenue from 2018 to 2019 of about $200 million. So you're really good in terms of the payout if they can maintain that. So Victory Capital has grown assets under management from $17.9 billion to $151.9 billion since 2013, and this is a growth rate of 43% per year. As mentioned previously, if you take out the USAA acquisition, that drops that growth rate to about 8.89% per year, which is still really good growth for assets under management. So one thing that they highlight in their annual report is integrated models with their franchises. And what they really are trying to highlight here is reduce costs with investing through a centralized distribution, marketing, and support functions, while allowing their franchises to retain investment autonomy. And that's really helpful. So it still has that local approach. A lot of these investment firms are smaller firms, with the exception of USAA. So it allows them to have that personal approach with customers and still allows them access to a bigger distribution, marketing, and support function through head office. One other thing I'd like to point out is the fact that franchises get paid based on the revenue they generate, not necessarily the profit they generate, and they're really trying to focus on providing value for their customer and attracting new customers through their investment franchises. So if we look at the funds in asset classes, we do see some spikes with the 2019 data, but over time we do see some growth of these funds, and the reason why we see some big spikes in 2019 is the assets under management that USAA brings on board. So for example, the money market had virtually nothing, and then it shot up in 2019. Large number of asset classes, fairly balanced in terms of the various classes here. So no concern that they're really reliant on a certain type of equity or a certain type of global market here. It is a fairly balanced portfolio. So with any investment firm, the goal is obviously to beat the market. And what we did was look at basically 3-year history here of how they performed relative to the S&P 500. Now, it should be noted that these are not exact figures. I tried to perform these calculations from their annual report that was issued in March of 2020. These may be slightly inflated figures here in terms of swings. But when we look at investing $10,000 on January 1st, 2017, where would we be at today relative to the yields that we're seeing? And what we'd see is with the S&P 500 index, we would still be on top. So we'd have a return of about 14,149. Their next best performing fund is the U.S. MidCap, which is still a few $100s away from the S&P 500 of 13,651, followed by U.S. Small Cap, Solutions, Global Non-U.S. Equity, Fixed Income, U.S. Large Cap, and money market. We put not applicable here because it just really entered into the mix of assets with USAA's acquisition, but it did have a 0.74% return, which is what we would expect for money market, generally not a very high return and a very safe investment. So when we're looking at how they're performing relative to the market, what we see is all of their funds are performing not as well as an S&P 500 index does, and they're not beating the market in any of their classes. So a little bit of a concern in terms of how they're doing and how they're adding value to their customers. Steady assets under management growth and steady revenue growth year over year. As mentioned, this is really what they rely on to make money year over year. So what we see here is steady revenue growth and assets under management growth. As mentioned, they use a 0.70% multiplier to make the revenue for assets under management. That's their fees. And of the growth from 2018 to 2019 of $81.1 billion, the $99 billion there is due to the acquisition of USAA. So that's why we see such a big spike from 2018 to 2019. So looking at the asset breakdown, as mentioned in the asset class side of things, it's fairly balanced, not too big of a reliance on a certain asset class. From a franchise platform, we see that, again, Solutions in USAA is really large in terms of the share, with some of the other funds taking up a smaller portion of it. But what I really wanted to focus on here, and this is coming from their annual report, is the heavy reliance on mutual funds. So that makes up 78% of their investment vehicles. And why that might be risky relative to something like an ETF is as the funds get withdrawn from mutual funds, generally your overall assets under management decrease. Whereas with an ETF, you sell your shares, somebody else will pick up the shares, and really what you're just worried about is your overall value of that fund and how that ETF grows over time for your fees. With this heavy reliance on mutual funds, I think this is a risk that we need to be aware of moving forward, especially as we go through some challenging times with the market. That's really going to impact their bottom line. Okay, going into some negatives. So as they're an investment firm, they're in a highly competitive market. There's many other vendors that are out there. There's big banks. There's some other top investment firms, Oaktree, BlackRock, that really compete with them in this area. As mentioned with the mutual funds, there's that strong dependency on that type of asset vehicle, so they are sensitive to decreases in revenue with client withdrawal. If funds perform poorly, clients may withdraw funds over time and switch to either other streams or switch to a different investment firm. And Victory is sensitive to market conditions. So as markets dip, assets under management dip as well, and that decreases revenue. So it's a one-to-one correlation with how the market is performing or how their asset classes are performing. So in order to sustain its growth, Victory Capital needs to basically keep their acquisitions up and keep that strong reliance on bringing in new assets under management year over year. They have done a great job of that since 2013. So, we expect that trend to continue to a degree. But the big swings that we're seeing in 2019 would be really challenging to keep that pattern up. I've listed this last point as a negative, but could be a positive as well, depending on what your view is. But they do have a 51% ownership by Crestview Partners. I would encourage you to Google Crestview Partners and see who is on the executive team there. Definitely interesting partners at that firm, and would just suggest that may be a risk, but I'll let you do your own conclusions on that one. So returning back to the intrinsic value calculation, we see that using a growth figure of 43%, we arrive at an intrinsic value of $310, though using a much smaller growth figure of around 9%, we arrive at a $51 per share value. So definitely trading at a discount. So in summary, while Victory Capital's growth does look impressive year over year, I would be concerned that it is able to sustain this, and I would be concerned that market conditions could lead to people withdrawing their funds. And as mentioned, they have such a strong reliance on mutual funds that they really could see that assets under management decline over time. So as a result, I really don't see anything special about Victory Capital that would have me invest in them over a firm like BlackRock or Oaktree. And I think there's other firms out there that have more of a balanced portfolio that may provide good returns through dividends. Prudential Financial is one of them that I like personally, and they may provide a better return and a more reliable return through their dividends year over year. Thanks for checking out this episode of InvestU. Don't forget to click subscribe below and visit us at valueinvestu.com for more videos and information.